Hey, it's Sunday, March 15th. I just wanted to spend a minute to talk about what this coronavirus means to the stock market. And it's safe to assume that we're going to see similar responses that we've seen in China and Italy. So what I thought we'd do is take a quick look at those two countries to understand what's happened there since this crisis started. China was basically marching up even in mid-January when they were very slow in sharing information around the virus. But by the middle of January, they started to confront the reality that this was out of control, and they imposed draconian measures to really try to ensure that this virus would be contained and slowed down long enough for them to build hospitals and do what is humanly possible to prevent the spread of the virus or at least slow it down. So we saw this FXI ETF, which we'll use because we have that data. This is the large cap stocks in China, top 50, I believe it is. And so that was around 45. We saw an initial move down to below 40, so that was a decent move down. And then we had a bounce up when things slowed down a little bit. They changed their testing models, which basically underreported. But more importantly, that underreporting was only for a few days. And so I'm kind of surprised we don't see a bigger down move, considering that they really quarantined 50 million people. I'd say the stock market did, I thought, better than I would have expected. And on Thursday, no, actually, this would have been Friday or Thursday. Thursday, they made a new low at 35. So from 45 down to 35. I was kind of expecting a 50% move down, but it wasn't that bad. 45 down to 35. It would have been 23 if it was 50% drop. So you're looking at maybe just a 25% drop. Not that big a deal. I'm surprised. And then, of course, we have Italy. And Italy. I just pulled you up. Italy. HEWI is the ETF for the Italian exchange. So what we notice here is the market made an all-time new high on February 19th, which was consistent with the US and other Western markets. By this time, China had already plunged from 45 down to 39, and then the cases started picking up in Italy. And you can see here this was almost 20, and we hit a low of 11, so almost 50% drop in Italy. And they're getting hit pretty hard. They've closed down the country, and so you would expect something similar for the US market because we've been very slow in trying to contain this. So far, we're at 21 from roughly 30. Mid-Feb started to come down with the rest of the market. A little bit of a rebound here when China rebounded, and they were heading back down. We're at 21. So, we're down 25%. Kind of would have expected it to be closer to 50% down. And and the other thing is I went back and analyzed what happened during the Spanish flu of 1917 to 1918, and what happened to the stock market back then. And we really had, it was really the spring of 18 that things were really bad. And then it all really ended in May of 19. So what's interesting is we had some infections in 17, but they were primarily in Europe. And it was only in the springtime that we really started to see the infections kicking in. And then it was just deadly in the fall. I mean, people were dying within 12 hours from infection. And that continued really into May. But what's interesting here is if you look at this, although places like major cities did close down for 3 months, no restaurants, no bars, no theaters, the virus went away in May, and then in May of 19, So, really by February of 19, with basically this is when the war was over, it already started moving up. So what's interesting here is for the Spanish flu of 1918, you could see how the market hardly reacted to that. It really went sideways for the whole year and then went and rallied up. So this is a bit baffling to me. They did close restaurants and bars, which will happen in the US this time. I would have thought that if you shut all businesses down, I would have thought you would be looking at more than a 50% drop. But what we're seeing here is, unless I think there were some infections in 17, but I don't think they were that big of a concern for people. They were mild cases, and it was basically the virus mutated in the spring of 18, and things were slow during the summer, but it was in the fall. It was probably really in here after we'd probably gone up from 75 up to 89, the Dow Jones. It was really probably in here that we really got hit hard. But look at this. It's such a small move down. We really hardly moved down at all. So it's kind of interesting to see. It's hard to believe that something like the Spanish flu would have slowed the market down or just basically moved it sideways for a year. But that's what happened in 1918. So there you go. We've got Italy down almost 50%, and the U.S. is, I think, following in line with what Italy has done. Or I would say the U.S. is slower than Italy even. China was the quickest to respond, and their market's down, but maybe 25%. So interesting to see what happens. The data suggests that in the U.S., the stock market could survive a pandemic like this. But Italy is showing us something different, and China, really, their stock market's not hit that bad. So I guess the summary for me is I'm a bit surprised the markets wouldn't go lower than where they are. So there's probably a point in here when you have to start saying, okay, which companies are going to survive however long this is going to take, and that would be like grocery stores as an example. And maybe those are the stocks to start thinking about buying here as we make each move down. Maybe you nibble a little bit on the way down. Otherwise, I'm still shocked that with the expectations on earnings and growth, I still think you have to re-rate everyone down 50%, but who knows? It's anyone's guess. But that's a little insight on the data, which I thought would be interesting.